tired of all the uneducated noise you're getting from the droves of YOLO meme coin peddling douchebag gurus out there trying to use you as their exit liquidity? Would you rather learn a competent university-level set of skills that will guide you in managing and investing for the rest of your life? Join us 3 days a week at Digital Investor. Develop your knowledge of game theory, cognitive bias, macroeconomics, monetary theory, investment theory, psychology of the crowds, and more. For more info on Digital Investor and how it can help you, reach out at nickblacknext.com.
Hello, good morning, good afternoon, good evening, good middle of the night, somewhere. Hello, hello. All right, let me bang through these comments. Oh, by the way, for those of you that are maybe you're driving or whatever, and you're in a spot where it doesn't make sense to watch the show, we are taking this show office hours, so not the Monday, Wednesday, Friday, and for the digital private clients, the Saturday shows, but the Tuesdays and Thursday shows we're putting on Spotify. So, and you can just look it up under Digital Investor, or we'll put links in the Telegram group, stuff like that. So anyway, if you just want to listen while you're cruising or whatever, and you don't want to go through the YouTubes, so right after the show, I download the audio and I push it to Spotify. All right, there's that. Okay, what's going on? I'm knocking out these comments, see if there's a couple of questions we can tackle, and then we're going to talk about 10,000 foot. We'll talk about the markets getting hammered. They did fine during the day, and then they got really beat up in the evening. I think people took a lot of losses all over the greater tech sector, and just in general, the markets got their asses kicked. The S&P got nailed. I mean, you can't lie forever, right? Like, these companies can't lie forever. And Jerome and the other, dummies at the Fed can't lie forever. They can't. And even if they're not lying, even if they're stupid, I'm not sure what's worse. You can't get away with, like, where's grandma? No, she's in here. Okay, let me see grandma. Well, she doesn't want to talk right now. Okay, I'll be back tomorrow. Like, at some point, I need to see grandma has a pulse. Grandma's the economy, and grandma ain't got a pulse. These companies haven't been producing. They've been, all this soft landing rhetoric and bullcrap. It's all stupid. I don't know if there's ever been a soft landing. It's kind of one of the dumber, but then what are you supposed to say as a central banker? It's coming unglued? Because what are your tools? What are the tools as a central banker you have at your disposal? Well, we'll lower rates. Okay, but does that do anything? No. Has it ever done anything? No. Did Alan Greenspan even admit that he didn't even believe that moving the short end of the yield curve did anything? Like that it actually produced zero. We know QE produces no results. So that's already off the table. That's not even a consideration. QE was dead. That sucker was dead on arrival. But the only other tool they have, remember, there's the monetary tools at the disposal of the Fed, other than just making up spammy ass special purpose vehicles for ridiculous things. The only tools they have are some tiny measure of near-term yield curve control with their Fed funds, which again, they just wiggle around this Fed funds and they expect that to equate to some change in the economy, which, by the way, that's all derived from the Phillips curve, which isn't a curve. That's a whole other thing. You could spend, man, they could teach whole college courses on how the Phillips curve is a smattering of dots. It doesn't look like a curve. It's a Phillips cloud. Like you're looking for some curvy shape so that you can say, oh, if inflation's here, unemployment's here, we just adjust the yield curve. Only it's not a curve. It's a cloud. It's a big gooey cloud. There's no curve in there. Doesn't even, it's just a big ass murky cloud. If anybody wants a good laugh, when some economist starts quoting the yield curve, ask them to pull the yield curve up and show us the curve. I'm like, that murky shit right there, that cloud, that's your curve. What way is it curving? So, and this idea that, oh, well, we have too much employment. Too much employment. We gotta slow down employment. What kind of weird backwards ass thinking? That's how you know that they're using poorly mathed out, bad econometric, dummy models that they got in 1962 when they went to college in their Ivy League garbage. And then when they got out in the real world, which they didn't last very long, because a few of these people have been in the business world, but mostly not. Politicians, a few of them have been in the business world, but mostly not. They're professional politicians. Bureaucrats tend to be professional bureaucrats. Like they don't know, that's why they don't know how to run a business. And if you treat a country like a business, you run it into the ground. So, anyway, yield curve control. Woo! So I thought that, because we've been in a recession for quite a while, like the whole world knows this. The only people that don't seem to admit to this, they obviously know it, but it's like Janet Yellen, who was quoted saying there'll never be another recession. I don't even know what that, I don't even know how you say something that stupid and your brain doesn't explode and just pour out of your ears and you just keel over dead. Who knows? Maybe she is. Maybe they're weekend at Bernieing her too. But then you have all these, God, these people, these economists. Anyway, long story short, I thought they were going to cut rates in July. I thought they would be cutting by now. And even Dudley came out recently and he's like, we should be cutting. And then he admitted, you won't, because he's, out of FRBNY, what he was with the Reserve Bank of New York. And Dudley was kind of a fool. Dudley's been a hawkish fool for a long time, and he's gotten everything, like all of them, really, really wrong. These guys are so wrong. They're Kramer level wrong. They're so bad at this. It's Kramer level of incompetence. I used to like Jim Cramer, but he's a dummy. He's either a dummy or he's a willing participant in some kind of, I don't know, practice of preaching stupid on a regular basis. Like it's so bad. You can bet there's an inverse Kramer play that you can make where whenever he says to sell something, you buy it. I think it's like in the 90% payoff. Right? It's great. Anyway. So just be very careful. And so part of today, what we're going to talk about is there's a lot of stupid floating around, which is good. See, sometimes I get frustrated. I'm like, look at all these stupid people. You're driving on the road. There's a bunch of jackasses thinking that those lanes are their lanes. Mother effer, it's taxpayer lanes. Those are all of our lanes. We each have a little bit of space. Then that jurisdictionality kicks in. You think it's your stuff. Ain't your stuff. Taxpayer stuff. That's our stuff. So it's passive aggressive, or the citizen cops on the highway, making sure everyone else drives the speed limit. Hey, bro, speed limits weren't introduced to save lives. Speed limits were two parts: one, to raise revenue, and two, to kind of protect oil usage and things like that. Had zero to do with safety. Go on, go look it up. Go look it up, you internet nerds. If you're like me, yeah, has nothing to do with safety. Speed limits have nothing to do with highway safety. Zero. Same thing with those little yield deals. You know those little lights like that tell you when you can get on the highway? Oh, no, not yet. Hold on. You guys take this red light. Wait for 12 seconds for no reason. Okay, now you can go. Do you think that manages the flow of cars into traffic? No, cars zipper into traffic. That's the best way, like particles. Do you think there's stupid little stoplights between your capillaries and your veins where the blood gets, oh, hold on, blood cells. Everybody slow it down. There's you capillary blood cells, you slow it down. You got vein action. And then they got to slow down the veins going into arteries. Got our traffic to fuck bullshit. It's so stupid. Anyway, we could do a whole thing on traffic. There's a lot of cool game theory in traffic. There's a lot of mechanism design, which is the other side of game theory, that goes into designing traffic plans. Like when they do, for those of you that are into super nerdy architectural game theory type stuff, go look at when they built, I think it's called the High Five in Dallas. It's like a bunch of roads crossing and like in all sorts of very weird ways. And it goes way up. It goes like 100. I think it goes 100 or 120 feet up. It's the craziest thing you've ever seen. And it took a long time to build. And like, feels like most of my childhood. Like every time I was in Dallas, just feels like they were still building that. And they may still be building it. But anyway, look up the High Five. It's insane. But there's a lot of game theory that goes into, okay, how do we connect these roads? How do we look at the traffic patterns? There's a lot that goes into it, which is interesting. That stuff's interesting. So the building side of it's mechanism design. The other side of it, that's game theory. That's how people play with it. That's how people mix it up. I don't have coffee. Zero coffee. You know why I'm excited? Is it a disaster? Listen, sometimes it goes wrong. Sometimes they get it wrong. You guys know what today is, right? Hold on. Let me just like Superman. Yeah, mother effers. It's Deadpool Day. Deadpool and Wolverine. I don't want to hear your crap. Don't need any coffee today, Bill. I've got crypto markets plunging. The S&P getting its butt kicked. Top level of High Five is 6. Okay, 60 feet up. That's crazy. All right, maybe it just feels like that when you're up there. All right, so I didn't realize they were all. Oh, so okay. We're going to talk about you hear these terms. Well, one, we're going to go over markets from a wider perspective. We're going to look. We will dig in tomorrow. The Ethereum ETF's been successful. Surprise, surprise, Grayscale is getting mutilated. I guess they're going to have to fire another CEO. Those guys, they're just greedy and stupid. But again, what they did was game theoretical. It's based on game theory. Their decisions were their decisions based on the people that they saw in that fund. Essentially, imagine a bunch of people that have been in the ETH fund for a long time, this Ethereum fund that they've had. It was a fund, it was a trust, not an ETF, not an exchange traded fund. It's certainly not spot settled. So what they did, and the way those funds worked is you could invest money or you could invest Ethereum. Same thing with their Bitcoin. You could invest Bitcoin or you can invest cash. And on the other end of it came shares, which you couldn't go the other direction. It's a one-way gate, right? Bitcoin and cash go in, shares go out. If you want out, you have to sell the shares. You sell the shares, you take your loss on the fee that they collect. That's it. That's how it works. Okay. And so you got to be careful. You have to look at the fee structure and the way fees are implied on ETFs. Different ETFs have different fee structures, and those fees get applied at different times in different ways. So you got to be careful. Just make sure you know what you own. So in this case, when Grayscale, it's not like we didn't know what it was going to look like. Grayscale unwound their Bitcoin fund. When the Bitcoin ETF started, they launched their Bitcoin ETF. And so what was the result of that? Well, interestingly, why is my phone not charging? Let's start charging, bro. I got this cool charger on eBay. It looks cool. I don't think it works. because like my phone's on there and it says my watch is charging. Bro, my watch is right here. There is no way that what it says is doing. Now it says it's not doing anything. I don't know. Be careful what you buy on eBay. Get what you get. Temu, that's where I go. Buy straight from the Chinese. Let them put their little listening devices right into my brain. I don't care. Ain't nothing magical going on here. Anyway, so they unwound when Grayscale went from their Grayscale Trust to the ETF because July 10th or 11th, we had Bitcoin spot settled ETFs. Yay. And they started losing money and they started hemorrhaging Bitcoin. I mean, cash, basically people saying, I want the F out. A lot. They hemorrhaged and hemorrhaged and hemorrhaged. Matter of fact, they hemorrhaged so bad, some days it was kicking the market's ass just because people were like, I want out of Grayscale. Enough so that, and they didn't say it was because of this, but the old, was it Michael Sonnenschein, whatever his dumb name was, that dummy got nuked. He got booted. Oh, I'm going to pursue I've got other things I'm going to pursue. Unemployment, bitch. So he's gone. So there's a new CEO. The king is dead. The king is dead. All hail the new king. Now we have a new one who just made a different level of the same stupid ass mistake. So they launched the ETH fund. And of course, these idiots have the highest fee structure. Some people were calling it brilliant. I don't know, man. I think because math, no. And so, and this will make more sense as we cover some of these stories, but so they have the highest fee at 2.5%, where everybody else is like a tenth of that. So they open a mini fund also. ETH mini, like a little mini fund that only has 15 basis points, which is low fee. They're like, well, everybody will just leave the high fee for the low fee. No, they won't, dummy, because people don't like Grayscale. People that want out of Grayscale don't want back in another spammy Grayscale fund. This is the problem is when you burn people, they're probably not coming back. I don't understand what the people at Grayscale don't understand. Anyway, surprise, surprise, they're hemorrhaging a shiza load of Ethereum because, well, basically they have to get out. So people are getting out of the fund. They converted that fund from their trust fund into their ETF, right? So if people exit, they exit the share. People have to go. Well, the fund itself goes and sells Ethereum. I mean, they put $1 billion of Ethereum. Oh, I think it was on Kraken to prepare for this. They knew it was going to hemorrhage. So you start to wonder, like, what's going on over there? I know that I figured they just looked at the math and they thought, well, this many people will move to the mini fund. We'll keep this much money. The people that stay, we'll be able to just stroke them for 10 times the fees that anyone else is charging. And look at us winning. Yeah, not if your whole goddamn fund unwinds, dummies. This is like common sense, man. And there's a bit of audacity. I don't know. I don't even know what the word. It's a kind of a prideful disdain for your clientele. When you say, Donna, when you say, will it come back? What do you mean it? That indirect object pronoun is intriguing me. Grayscale. Proud to be the Merrill Lynch of crypto. Craig just won the internet. Craig, you just won the internet. Let's see. Oh, BTC's back up. Oh, it's down. It's up. Gosh. I did some buying last night. I'm not going to say. Oh, will Ethereum come back? Well, yeah, this has nothing to do with Ethereum. Matter of fact, this doesn't have much to do with crypto. So let's go and talk about the news a little bit. And as we go through the news, we're going towards a point where I want to discuss a couple of phrases that we hear a lot, we throw around a lot as investors, as savvy investors that we are. And, oh, there's blood in the streets. Go and drink some blood. No, that's a vampire thing. No, if there's blood in the streets, go order a McDonald's meal. By the way, on Uber, if you spend $20 on McDonald's, it gives you a free chicken McNugget meal. So I did that yesterday just to get the free meal. I spent $20 and I got a double quarter pounder with cheese and bacon. Oh yeah. Yeah, I did the bacon. And I got a chicken McCrispy something. It's a something. McCrispy maybe? It was not crispy. The chicken was good. The bread was not so good. But then the free meal that came with it, they must be trying to get rid of those chicken McNuggets because they're very gross now. They're not the way I remember. I think the last time I had a chicken McNugget was when I was like 7. When I was 7, I was dipping those suckers in honey like a bee. It's like a little bee. Anyway, those are gross. It was real bad. And so I ended up throwing away the chicken McNuggets, throwing away the fries that came with it because those are crap, throwing away the drink. So that whole thing was wasted. Then I got a hot fudge sundae. Well, turns out that doesn't transport well. So when I got it, to go between the time I took it out of the bag, the 4 seconds it took to put it in the freezer to preserve it while I ate my burger and my chicken McCrappy, it melted and the goo came all the way down and then froze into the freezer. You know how hard it is in a sub-zero freezer to unfreeze stuck goo and get it out before it refreezes? Has anybody done that? It's harder than Grayscale figuring out their fee structure. I promise you that. Anyway. All right, let's get on some news. Let's get on some good news. Well, that was good. Let's talk about why things went down. Bitcoin and Ethereum plunge. Say the word plunge. That's some serious crap. When you hear people say plunge, I mean, I think a plunge is 5%. 5% is a plunge, is it? I mean, in crypto, like 10% is a plunge. But I guess we'll give it 5%. 5% is a crash in any other market. In crypto, 5% is like a Tuesday morning. But Bitcoin and Ethereum plunge after U.S. tech sell-off, sparking $300 million in losses. It's way more. I think it's more because usually these losses cascade. It's the high leverage dummies. It's the medium leverage dummies, the low leverage dummies, then the margin account dummies. It takes like 3 days for all of this stupid ass leverage gambling, jackwagon, idiot kind of gambling to unwind, right? So strong outflows from spot ETFs also contributed to the downward market pressure. That's not quite true. I know it says that's the case, but that wasn't the case. The outflows from the ETF yesterday didn't really affect Ethereum's price, but by about $100. Not much, 2%, 1.5% all day. And then towards the evening, I think maybe people realized they were licking their wounds. They're like, Jesus. And they looked, to an extent, they probably looked at all the leverage, all of the gamblers, all of the dummies that got whacked. 300 million. They figured, hey, it's probably another 300 million coming just as this all propagates out. So anyway, the crypto market declined by about 5% in the last 24 hours, aligning with a significant drop in U.S. stock shares. Yeah, no crap. This sent global markets downward. Yes. Remember, when there is a catastrophe or chaos, all things are correlated one, meaning full correlation. When the ship is sinking, it's all going down, right? Everything. And sometimes you use your winners to pay for your losers. I had a lot of cash on the sidelines waiting. The markets were kind of up and down the last couple of months, mostly up in certain places. And I just followed my rules. 10x take 20, 2x take 10. And if I had any lottery tickets, if they would double, I would take, half off the table. Or if they got a triple, I would take, half off the table and or at least my original investment back. So I've been stockpiling cash for a rainy day. Looks like we got some rain the last couple of weeks. So anyway, Bitcoin's price fell. What is that? No, I'm not going to subscribe. Why does it do this? And then you can't find the little X, the thing to X out. Anyway, Bitcoin's price fell almost 3%, falling from 67,000 to around 64,000, while Ethereum experienced an even steeper decline, dropping nearly 8% from 3,400 to about 3,100. And even right now, I think it was like 3,120, 3,130, something like that. So it's kind of in that range, which isn't like total chaos into the world type stuff, but you know, it's something. Anyway, other major digital assets, including BNB, Solana, crappy Dogecoin, and Tonecoin, also face notable losses, each falling by more than 5%. This is how you can see when they write these articles. All you have to do is read a little bit into the articles and see which tokens they talk about as they quote what's up, what's down, and all that. That's how you know who's paying them. So my guess is contributors to Crypto Slate, because it's Crypto Slate data, are Solana, Tonecoin, BNB. You know, that you can tell where, or it's funds or investors behind them that own those assets. So this gives you always, you know, you got to weigh your news. So you can trust most of the major numbers, but then when they start talking about individual assets, you got to be a little skeptical. Anyway, analysts, unnamed analysts, we don't know who they are, but they're analysts. They highlighted that U.S. stock markets faced their worst day since 2022 yesterday, driven by a massive sell-off in tech companies benefiting from the artificial intelligence boom. Reports revealed that over $1 trillion was wiped out from the market due to the situation. Remember, those losses are only going to be experienced by about 16 people out of 100. Don't cry for them, Argentina. The NASDAQ Composite Index dropped 3.6%, marking its worst performance in 2 years. Yeah, well, I mean, at some point, #recession, jackasses. All these companies can't bullshit and promise a great future quarter after quarter and never deliver. At some point, people are going to be like, look, man, you gave us forward guidance. You told us about what the future was going to look like. You told us about the next 3 quarters. It's all been wrong. You said you're not firing, but you're cutting job hours. You're cutting hours. You're converting your workforce to part-time. You're offering severance. Yeah, but those people aren't fired. You gave them severance. It's the same crap. So, you know, a lot of these companies, their goose is cooked, and at some point they got to turn in a bad quarter. I think that's what they do is they bullshit for 2 or 3 quarters, and then they turn in a bad one. Okay, now we can bullshit 2 or 3 more quarters. And so these things all lump up together. And don't think they don't talk. Don't think these companies don't go compare notes when they're at the urinal. Where are you at? Oh, I'm getting crushed. And we're getting crushed too. You gonna turn in a bad one? Yeah. Yeah, I think we will too. Yeah, flush it. Let's get rocked. Anyway, the S&P 500 fell 2.3%, its most significant one-day decline in over a year. And the Dow Jones Industrial Average, filled with just whatever is in the Dow Jones, decreased by 1.3%. Notably, let's get back to crypto. The substantial outflows from the Ethereum Exchange Traded Fund ETF products further contributed, not all of them, by the way, not all of them, further contributed to the market's downturn. Over the past day, ETH-based ETFs saw outflows exceeding 133 million, with Grayscale Ethereum Trust alone experiencing $326 million, almost $327 million in net outflows. So let me say this again. And for those of you that are quite savvy with your math skills, if you're savvy, if Ethereum ETFs lost 133 million yesterday, you with me? Is everybody with me? Are you with me? And Grayscale alone was 327 million of the 133 million. Oh, that's right. So Grayscale is shitting on the entire market. Strange. It's crazy to imagine that Grayscale is blundered it again and that they are hemorrhaging. You take away Grayscale's losses and you have about 200 million inflow. Yeah. Right. So they wiped out what would have been a good day. You can thank the assholes at Grayscale for, again, getting it wrong. Marcus Thielen, the founder of 10X Research. Damn, 10X Research. Pay attention. You're getting more. You're getting an order of magnitude more than everyone else. The rally into the Ethereum ETF launch is finally over. All crypto listings have seen a ramp up into the launch, only to become sell the news trading opportunity. Well, that right there is using the research to formulate a lie. That is not true. That is an untruth or a half-truth at best. Grayscale is getting fucking nuked, and every other fund is doing just fine. So, come on, man. God, get off the gas. Part of that 10X, at least 9 of those 10Xs should have been looking at what actually happened rather than just looking at the headline and putting out your 10X research. These guys like to come out and pontificate. Oh, so let's sell the news event. No, it's not sell the news. It's sell the Grayscale because their fund is set up stupid. Otherwise, it's buy the news because all the other funds took in plus 200 million. It's only Grayscale that's getting their ass handed to them. Anyway, the red markets trigger around 300 million in idiot liquidations. CoinGlass data shows that the broad red market situation resulted in significant losses for crypto speculators. They are definitely speculators on the prices of these digital assets. According to the data, over 73,000 traders face liquidation. 73. What bunch of idiots? If we know 73,000 traders face liquidations totaling around 300 million, with most of the losses suffered by long traders betting on price increases with leverage. This cohort of dummies approximately lost 267 million, basically the same that Grayscale lost. So I guess they're dummies too. While traders with bearish sentiment were also liquidated for being bearish at the wrong time for about 30 million. You got to be a damn fool when the market goes down 5.5%, 6, 7%, and you're short and you still lose. What kind of a damn fool are you? You can't even get that right. You can't even win for losing. Dear God, man, there are a bunch of jackwagons out there. Listen, if you're going to be a leverage gambling fool, fine. At least know how to put your damn bets in. Jesus, man. How the hell are you going to lose? Anyway, across assets, Ethereum and Bitcoin traders experienced the highest liquidations, no doubt, with totals reaching about 102 million and 83 million respectively. So, wow. And the dumb get dumber. Crazy, right? Okay, let's push over and let's talk about this. CoinDesk 20 performance update. Broad-based decline hits all 20 assets, sending the index lower by 4.4%. That's 4% is a lot, I guess. Okay, real quick, let's look at these assets and see which ones don't belong on the list. HBAR, this is the CoinDesk 20. Okay, again, so this is how you know that CoinDesk is like, what? First of all, Hedera Hashgraph, HBAR, no, shouldn't be on the list. Cosmos, I like the company, but it shouldn't be on the list. This is not a bellwether asset. ETC, Ethereum Classic, Aptos, Link, Avalanche, Solana, Litecoin. Get the fuck out of here. What a dummy list. This is, none of these assets should be on a top 20 anything. Anything other than if you just go by, if you're just ranking by market cap, where's Dogecoin? Where's Pepe? If you have dumbass coins on here, Hedera, what's the market cap? $40? Me and the DPCs could buy that company and flip it. I got $60 in my car. You guys go scrounge in your couches. Me and Mac, buddy, I don't know if you're listening. Mac, let's go buy Hedera and flip it. Get off the gas. Hedera, Cosmos, Ethereum Classic. You guys know what Ethereum Classic is? That's the shitty remnants of what's left when Ethereum forked. Ethereum Classic. So what a stupid ass list. But the overall insight is if we get past this list, let's go look at the other list. XRP, Y, ICP, Y, Polkadot, Y, Bitcoin, yes, Filecoin, fair, Bcash, come on, man. Doesn't even make any damn sense. Near, Render, Uniswap. What goddamn list is this? It doesn't make any sense. My brain is melting. Oh, what a dipshit group of assets. Do they have a last batch? Oh, laggards. Oh. Anyway, so that is a little. And again, I like CoinDesk articles. CoinDesk has good articles. But if you see this is their, this is the 20 assets we follow. These are the bellwethers of the industry. Bullshit. So CoinDesk, there's another one that cannot be trusted. I'm just going to nuke that article. Okay. See, you got to be careful when you read news. There's a lot of propaganda in the news. CD20. I'm sure that's their stupid ass fund that you can buy. I'm sure there's a token against that. We're going to just release dumbass article token. That thing would be huge. Anyway, okay. Ethereum down over 7.5% as ETH outflows ramp up. Okay. Now let's talk Grayscale. Most Ether ETFs were in the green during the Wednesday US trading session, except, but Grayscale converted Ethereum Trust ETF posted a new net outflow of over 800 million. Ethereum is down over 7.5. They wrote that stupid. Here, let me just leave this little chart up here and then I'll go through it in a way that won't make all your eyes bleed. Ethereum is down over 7. They put the dollar sign, but you don't do that. But anyway, 7.5% is trading above 3,100. Ether's decline comes as the ETH. So this is the Grayscale fund, ETHE. Outflows continue, and tech giant NVIDIA trades in the red. Yeah, NVIDIA was way up and then got beat up a little bit. Anyway, Ether, ETH, down over 7.5% in the first hours of East Asia's business day. Trading hands at 3,100 as the market continues to be concerned about outflows from Grayscale's converted Ethereum Trust ETF, which is ETHE. That's the Grayscale fail. The Grayscale fail. Maybe they should have that. Great G fail. That's a good fund. G fail. I bought Ethereum yesterday. I'll say it. I'll say it to your face. I added 12%. 12% to my Ethereum, not to the portfolio. 12%. I bolstered my Ethereum by 12%. Okay. Market data from Soso Value. I don't know if I trust anybody that would name themselves so value. Anyway, shows that ETHE had a net outflow of over 810 million. This is similar to the first weeks of Grayscale's other major crypto trust, GBTC, when it experienced heavy outflows during its first week of Bitcoin trading earlier this year, Bitcoin ETF trading. Most other ETFs in the Ethereum space continued in the green for flows during the Wednesday session, with BlackRock's ETH leading the pack with 283.9 million inflows, followed by Bitwise ETHW, which registered 233 million in inflows. And in third place was Fidelity's FETE, Feth. It sounds like someone with a lisp. Feth up. You did it. Feth, F-E-T-H, that clocked 145.7 million in inflows. Ethereum is down 6% in the last month, still up 72% in the last year. Overall, Ether outperformed the CoinDesk 20, an index that tracks the largest digital assets to date. And that's a fucking lie, because these are not the largest digital assets. The CoinDesk 20 is not, it's not the largest assets. You can't have, listen, man, if it's not the top 20 assets, then it can't be the top 20 assets. Like if you go the top 20 by market cap, if your index has assets that are not in the top 20, then guess what it cannot be? It factually cannot be the top 20 assets. Can't be, because math. Anyway, and they even say the largest digital assets. Yeah, except math. Anyway, the CoinDesk 20 index, if you listen to them, you're up 21.6%, which isn't bad. But if you had just bought Ethereum over the same amount of time, you're up 35%. If you just bought Bitcoin, you're up almost 100%. If you just bought, I could go on and on. These guys, man, they're kind of dumb, man. They're dumb. Well, they don't trade. None of these guys are investors. They're just, this is it's us and the guy that collects comic books. We're going to get together. We're going to pick 20, what we think are the greatest, the biggest, the most grand. What about market cap? You shut up, Marty. You shut up, Marty, with your market cap arguments. You go back to accounting. Oh, okay. Marty from accounting always gets spit on. Anyway, so let's switch gears a little bit. We know that markets are in the red. We know that there's a bunch of bad math. There's a bunch of stupid floating around the market. There's a bunch of stupid at the Fed. We talked about that. There's a bunch of stupid on CNBC and everywhere else that you listen. There's a bunch of stupid. And mostly because they're just regurgitating other stupid, or they're pandering for their backers, right? Someone pays the bills and you toe the line. Okay, I get it. Either way, if you're listening, there's noise and information. And there's very little information right now other than the math. We know the math. The Ethereum ETF's doing quite well. One of them is getting gutted. All the other ones are doing great. Like great, right? We saw numbers from 300 million up to 800 million of inflows, only to be usurped by the idiots at Grayscale hemorrhaging. So this is not an Ethereum story. This is not an ETF story. This is a Grayscale story. Maybe we should call it brown scale, because that's what it sounds like. So that being said, you can tune out most of the Ethereum noise and most of the ETF noise, and you can kind of tune out the price action. And what can attribute to it? Well, there's no one specific thing. Ethereum outflows, that's part of it because of Grayscale, right? Somewhat. Somewhat is, a lack of enthusiasm because the tech sector got beat up. Because again, you can't survive on whimsy and bull crap forever. Like at some point you have to turn in consecutive good quarters. Your guidance needs to be good. Your company needs to produce. You need to quit laying people off. And if the opposite of those things happen and the world starts to remember that it's in a recession and be a little bit more honest and genuine, it's like, oh, well, we're going to get the Fed rate cuts, right? Good. But rate cuts don't do anything but create a little bit of kind of weird euphoria, stupidphoria. Like, what is the word for euphoria based on dumb? Hope, whimsy, swamp gas? So the Fed is dumb and will tell you dumb stuff. Politicians are dumb and will tell you dumb stuff. Analysts are dumb and will tell you dumb stuff. You can get a little bit out of the math, but you got to be careful about how that math, top 20 assets. No, not the top 20. The top 20 CoinDesk assets as picked by, comic book Larry and two stupid dumbass, interns, while Marty from accounting is getting shit on. All I want to hear from is Marty from accounting. So when you look at all that, as far as the crypto space is concerned, there's really no bad news. We have the overhang of Grayscale. Yes, that sucks. Got to get past that. It's a mess, but we will. People are going to sell Bitcoin. Not all of it, some of it, potentially half of it. Anything less than half would be great, because that'd be just about the same kind of damage as Germany caused. And Germany that is no more. Germany that, by the way, because of their very prolific, very public selling, we're going to sell. We'll show you, world. This is how we We thumb our German noses at Bitcoin. We sell it with reckless abandon. Cool. Well, you cost your country $1 billion. Do you understand what you have done? I think that the Führer would not be pleased at what you have done. Dumbass bureaucrats. They should have listened to Marty from accounting. Marty was like, dude, what are you doing? Buddy, what are you guys doing? I bet those dumbasses, I bet they didn't even short. I bet some people did. Smart people did, went out and shorted against it because probably insiders knew. Of course, insiders knew, because nothing happens in any European country that there's not 100 insiders pulling old sketchy shit across it. But as far as the actual bureaucrats, I'm sure, and Mati from the accounting unit, I'm sure he brought this up. And they said, go away, Marty. You're an idiot. You're a fool, Marty. And Marty was like, Scheiße. And he went to his office where he does math. They could have shorted it. They could have bought puts. There's all sorts of things they could have done to make money. Did they? No. Idiots. Anyway, so when you have all this murky, gooey, bad, noisy environment, it makes it, for those of us that actually listen to Marty in accounting, you have a good opportunity. And so then we got to talk about the mindset. So we're going to focus a little bit on the kind of investment mindset, a little bit more Charlie Munger-esque, if you will. So our Brainiac part of today's session is going to be, we're going to talk about, let me get this banner off the screen because I think we get it. Is it time to be greedy? When is it time to be greedy? And how greedy should we be? Interesting.
Hello. You're late.
You're bad at math, but I'm giving you an A+ in confidence.
Just doing what I gotta do.
Extra credit.
Okay, real quick. Who here is greedy? There's 133 people listening live. You know, it's interesting. You know, on Spotify, you can do comments now. You can do comments on a podcast on Spotify. It's great, Craig. I know. Anyway, who here in the chat live on this Thursday at 8:48 a.m. Pacific time is greedy? Yes. Yes, greed. I see a lot of greed. Greed. Good. Greed is good. Because if you are intelligent and greedy and have some molecule of decency in you, that greed can propel you to make oversized, outsized, many multiple rewards, and then you can distribute them in the way that you best see fit. You can be a kind, benevolent ruler, but you can't be a kind, benevolent, broke-ass ruler. You can't live in a cloud city if you can't build your crowd city. Listen, I'm not saying I didn't say anybody here was 100% greedy. Not greedy, but aggressive. Get greedy. Greed is good. As long as you're not all greedy, there's got to be some altruism in there somewhere. It's an index, man. It's an index. So today we're going to look at the kind of, let's call this the wisdom of Warren Buffett. It's not just about Warren Buffett. I do talk a little bit about a British individual, but let's look at the wisdom of Warren Buffett as maybe our binoculars for dealing with these down markets, which I like down markets more than I like up markets, because that's where you do the real investing. Investing's done in down markets. It's not done when things are going up. You're exiting when things are going up. You're investing in down markets. So we're going to dive into a very critical concept in investing that can make a significant difference in your financial future. And remember, actually, I will say this is advice. I'm not telling you what to buy, but this is, they always said this should not be constitute financial advice. This is absolutely advice. This is damn common sense financial advice. All right? Common sense financial advice. Hashtag there's no one to sue. All right. So let's explore Warren Buffett's famous advice. You guys have all heard this. Be fearful when others are greedy, and greedy when others are fearful. Not stupid, by the way. Nowhere in there does it say stupid. Nowhere in there does it say leverage. No, those words don't appear. Be fearful when others are greedy, and greedy when others are fearful. And the related idea, as an aside, is kind of buying assets when there's blood in the streets. We kind of mentioned that earlier. Even if it's your own blood. So let's talk about Buffett's wisdom for a second. Well, one, you can't. Buffett and Warren Buffett and Charlie Munger are two of the most successful investors in human history, at least that we have history of. So you can't discount, even if you don't agree with them. Look, they're not big on tech. I get it, all that kind of stuff. But you can't discount how successful they are. So Warren Buffett, one of the most successful investors of all time, emphasizes contrarian investing as one of his main approaches. And so this means taking actions contrary to the prevailing market trends, the rhetoric, the noise, the chatter, the bull crap that you hear on FinTwit. Yeah. So let's talk fear and greed in markets. Markets are driven by mostly emotions. I mean, 99% emotion, maybe 1% math. And so when prices, right, sticker prices are soaring, greed and a kind of panic takes over. And everyone wants a piece of the action, right? So people come running in. Conversely, when markets crash or there's a sell-off, you get fear spreading. And another kind of panic kicks in. And that leads to massive sell-offs. All one way, all the other. And it's like a slow wave, right? So think of your late 90s dot-com bubble, excessive optimism, euphoria. It's never going down. This time is different. It led to a super inflated tech stock scenario. I mean, you could call it a bubble, but definitely tech stocks went way, way, way up. And then there was a significant crash. You remember pets.com? And it wasn't all tech stocks. It was anything that anyone could slap on a website and go over to SoftBank and get lending on. Anyway, or investment. But there was a big fat crash. In 2008, during the what is called the financial crisis, but it's probably a cash crisis, a monetary crisis, it led to massive panic, sharp declines in asset prices, a bunch of debt getting repriced, getting imploded. I mean, just the whole bond market just getting, blitzed. But it presented a lot of buying opportunities for people that were brave and they could see through the noise and the panic. Like, quit screaming. It's not really bleeding that bad. You're screaming because it's bleeding, but it's not that much blood. You just think there's a lot of blood. It's actually grape juice. It's delicious. Welch's. When I was a little kid, I used to drink Welch's grape juice. I was like, it's like wine. I'm like, I couldn't figure out why wine wouldn't taste as good as Welch's grape juice. It doesn't, by the way. Nothing tastes as good as Welch's grape juice. Nothing. I challenge you. Anyway, let's talk about blood in the streets and the mentality with blood in the streets. And this is something that I do on a micro level. So small e. When I see these big pullbacks, if there are assets that I because the market going up can sometimes be a crystal ball, especially on the way up. We know we're not at the highs for Bitcoin because Bitcoin slowly continues to take out new highs. We know we're not at the highs for Ethereum because the ETF just launched, and there's a pretty good amount of history and scholarship that would tell us that it's more likely than not. I mean, that's your decision is yours, but I think it's more likely than not that Ethereum does take out its highs, given a variety of factors, the staking situation, the ownership of ETF, and the ETFs owning Ethereum in their portfolios, and all of that, all of those tokens going away, right? So you take a third of the ecosystem is being participating in mining. Those tokens are gone; they're locked up. let's say another third goes towards these ETFs. That leaves only a third, which creates a highly volatile market, but it's essentially accretive. So when you have a sell off, like in my mind, I don't imagine a universe where Ethereum doesn't get back to $3,800, where it was just a month or two ago. I just don't imagine that universe. So for me, I can buy Ethereum at $3,100, $3,150, $3,170, whatever, $3,200. There's still some juice on the fruit, right? A couple more puffs in that cigarette. The original phrase, the blood in the streets phrase, this was Baron Rothschild, and he's an 18th century British nobleman. And he said, the time to buy is when there's blood in the streets, even if it is your own blood. And I think actually the direct quote was, even if the blood is your own. That's right, because he's quite proper. The time to buy is when there's blood in the streets, governor, even if that blood is your own. Well, it suggests that, and this is pretty, people have been investing for a long time. This isn't something that we created like just recently. People have been investing in markets since, late 1700s, 1600s, 1500s, tulips, keep going. Anyway, it suggests that the best opportunities often arise during times of extreme pessimism and market downturns. Tumultuous, tumultuity. I don't even think that's a word. I like it. I'm going to make a coin out of it. Anyway, when people are shizaing their pants, there's money to be made if you focus on the math. Look at post-2008 in the great monetary crisis. Investors who started buying in 2009, they crushed it in the following years. They crushed like hugely substantial returns. People in COVID-19, after the big market crash, those who started investing during early 2020 benefited quite a bit because the market recovered really rapidly because, we got to peak stupid again and they were giving away free money. These things always happen. Nothing's ever as bad as you think and nothing's ever as good as you think, right? So what is the mindset of a competent investor during these chaos events? Which this is the most important thing. If you can thrive when markets are down, you will do just fine always. It's having emotional discipline. This is crucial. Emotional discipline is crucial. Avoid making impulsive decisions based on fear or greed. Remember I said, who's greedy? It's good to be greedy. Make your decisions based on the math. But when other people are panicking and you're not, and when other people are FOMOing and you're not, greed plus math, that's just greed plus research, right? You can be greedy. Greed is your fuel. It's my fuel to do research and due diligence. So make informed decisions using your game theory, understanding your cognitive biases by researching the intrinsic or whatever kind of intrinsic value proposition that you can make for an asset. We use our 5 T's, right? So use your 5 T's or some structure to establish some level of intrinsic value, some way to score these assets, understand the difference between the price of a thing and its value. The price is what you pay, right? The value is what you believe it's worth when you melt it all down. What's the melt value, right? Think like a gold watch. What's the melt on that? Long-term perspective. Successful investors focus on long-term goals rather than short-term market fluctuations. They view downturns as opportunities and it lets you buy quality assets at a discount. Like I'll tell you what I bought yesterday. I'm not telling anyone to buy these things because you might not think they're quality. But I bought Ethereum. I bought Filecoin. Did I buy something else? No, that was it. Yep. Ethereum, Filecoin. Oh, there's something else I bought. Oh, I shared that with the digital private clients. Anyway, it is what it is. All right. So successful investors have a more long-term perspective, longer than a year, right? Investing a year plus, trading anything short of a year, 1 second to a year. So successful investors focus more on long-term goals rather than short-term little heartbeats, little market fluctuations, right? Short-term gains. No, they view downturns as opportunities to buy quality assets at a discount. And then some level of risk management. You have to have a risk management strategy. So diversification in your portfolio. I would urge you not to have only one asset. I guess if you have to have one, have Bitcoin. But if you have any more than one asset, 4 or 5 assets. We did this yesterday on the show, Behind the Wall on Digital Investor. We talked about the 5 assets that you have to have, or at least the 5 assets that we felt like we had to have. So some level of diversification. That's your good kind of proper risk assessment and kind of risk management strategy. And that will help you during volatile periods. Your whole book might sell off a little bit, but not a lot. And not every asset's going to get pounded the same way. And then you'll have certain markets that seem flat and 1 or 2 of your assets will rise. You'll feel good. So yeah, have some level of diversification. Okay. How do you apply this practically? So personal finance strategies. So, we talked about this Tuesday when we're talking about debt, but build an emergency fund of cash on the sidelines so that you can avoid selling investments at a loss during downturns. Don't sell stuff you don't have to sell, man. Take some cash, put it on the sidelines. Listen, you can keep cash at Coinbase. You get 5.1%, 5.16%. That's not terrible. That doesn't suck. Anyway, so build an emergency fund so you never have to sell at a loss. Anything. Dollar cost averaging. Invest a fixed amount on regular intervals, regardless of the market conditions. It takes the emotion out of it. As far as your career and professional growth, use market downturns, use these red days to invest in education, right? So when the markets recover, you have enhanced your expertise. And then your expertise, your intellect is a form of dividend, right? You're getting paid intellectual dividends. It's good. Market downturns can be a good time to start looking at new assets, things that you may have, passed them over, or maybe it was something you were kind of looking at, but you didn't pull the trigger on it. Maybe take a second look and you say, listen, there's an opportunity here. Let me do some research. Let me look and see if this asset, let me do my 5 T's and see if this thing might achieve use, utility, and wide scale adoption. So overall, if you're applying Warren Buffett's advice to be contrarian, as long as you're based on math and research, right? You will be presented with significant investment opportunities. Maintain a calm and informed mindset. Clean your fucking desk. Make your bed. Clean your shit. I'm telling you, clean your environment. You have to have a clean environment. If you have a messy environment, you have messy thoughts. Disorganized environment, disorganized thoughts. This is the easiest first thing everyone can do to improve their investing. Just improve their life. Clean your shit. Come on, man. So yeah, these downturns are good. Like, embrace them. They present challenges, but they also present a lot of opportunities. And I like buying when things are red. It's like I have a crystal ball. It's like I get to invest. It's like I get money for free. Because I have a strong conviction that certain assets will return to where they were, yesterday. And if those beliefs are true and you get a heavy enough market sell-off, well, then, in the immortal words of Baron Rothschild, the time to buy is when there's blood in the streets, even if that blood is your own. See, I went to Louisiana Noble on that one. Probably would be his accent these days. Anyway, stay in school. Don't do drugs. No. The 5.55 is a teaser for the first chunk of money, but when you get past a certain amount, it goes down to 5.16. Yeah. But anyway, yeah, for part of your money, at Coinbase, you will get at 5.5. No, man. There's no update on Twin. I'll try to get some information for you for tomorrow. For you guys, listen, man, listen. We don't hide stuff from you. If there's an update, do you think we keep it secret? Keep it in our back pocket? I'm not telling. I'm not telling about the secret. I keep it to myself. No, man. We share the information when we get it. That's why we have a whole TV show thing for YouTube 6 days a week. Cryptocurrency stuff, man. Damn. Ain't no news. Ain't no news. Twin token launch incoming. There it is. It's scrolling on the bottom. Yeah. What is it? Read it to me. Someone read it. Read what that says. Is there anything about new update? Twin token launch incoming. All right. I want you guys to all go and take a minute and think about what you did. Go to your room, think about what you did. I'm going to go watch Deadpool and Wolverine. And I'm going to eat a lot of popcorn. I'm going to eat a hot dog. And I'm going to throw up. And I'm going to go eat another hot dog to wash down the throw up. How about that? Stay in school. Don't do drugs. Don't do anything my poor insolvent drunk, strung on meth grandmother or Brandon wouldn't do. He says like 100 out there, 100 degrees. So I'm guessing he's tank topping it up. And he probably will also be going to see Deadpool and Wolverine. We will see you tomorrow for Digital Investor. And I will get this episode up to Spotify. Toot sweet.
If you're an accredited investor and you want in on angel, seed round or early round equity and token opportunities in the artificial intelligence and cryptocurrency space, schedule an interview at nickblacknext.com. In life, you can either be really good, really lucky, or just be first. Being first is so much easier. Schedule a digital private client interview today at nickblacknext.com.